The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to this month's ACECRT Financial Wellness webinar series, where we'll be going over JP Morgan's Guide to the Markets and Economy for Quarter 3. We appreciate all of you taking the time to join us today, and we just have a few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. However, please feel free to write in any questions you have using the Q&A tool on your webinar menu. And at the end of the presentation, we will take some time to go through these questions. And now I'd like to introduce our guest speaker, Jack Montague. Jack is a Vice President and Client Advisor with JP Morgan Asset Management. In this role, Jack is responsible for delivering timely market and economic insights to financial advisors and their clients, as well as consulting them around the depth and breadth of JP Morgan's investment solutions. He has served over 10 years in the financial industry and is responsible for the Los Angeles and Mid-Coast region with JP Morgan. Jack is an avid golfer and recently became the father of his first child, Patrick. Jack and his wife, Kelly, currently live in Culver City, California. Thank you so much for being here today, Jack, and now I'll turn it over to you.
Thanks so much, Tori. We really appreciate you allowing us to come on this afternoon's call and speak with you and your clients. We do appreciate the partnership that we do hold with PensionMark and look forward to today's discussion. We're going to do a couple things to kick this call off. First, I'm going to share with you a little bit about the history of JP Morgan and our partnership and why we're on today's call. And then, more importantly, we are going to discuss highlights and key themes from trends from the macro environment that we're looking from a global perspective in our capital market assumptions based off of our Market Insights series, which is the Guide to the Markets, which we publish here at JP Morgan. So let's get started. Who is JP Morgan? Obviously, JP Morgan is one of the world's largest, most respected financial institutions. JP Morgan is a name investors know and trust for steady, consistent management across rapidly changing markets. We are the 7th largest mutual fund firm in the U.S., and we actually hold $1.7 trillion of money entrusted to our investment professionals and our products. People use JP Morgan because of our experience in all types of market environments. We've managed investments for more than 150 years, and this has given us valuable experience across all market cycles. During that time, we have guided investors through the Civil War and every conflict and crisis since. We've experienced 31 recessions and recoveries that have followed, and we've adapted to shifting politics worldwide, including 29 different U.S. presidents. Through all of these changes, our mission remains the same, and that is to help clients achieve life's most important financial goals. We are a time-tested leader, and that comes through our investment professionals. We actually have 900 plus investment professionals in local markets around the world, and our portfolio managers actually average experience is 17.4 years, which is actually 3 times the industry norm by Morningstar. We have an annual research budget that is $269 million, which is an important number. It essentially means that we spend $269 million every single year just to perform due diligence, kick the tires, meet with companies, meet with investors, and find the most suitable investments for our clientele. Part of that research and what we distribute publicly is our Market Insights series and our Guide to the Markets, which we will be discussing today. The Guide to the Markets is commonly referred to as the most sought-after vehicle when discussing financial markets by financial professionals, institutions, and governments because it is market data in a purely objective fashion. Nothing from this guide will tell you to invest with JP Morgan funds or competitors, to be bullish, to be bearish. It is strictly the market data for you to interpret in your own personal circumstance. So what we're going to go through today are a couple major themes in JP Morgan's interpretation of that data, and then I'll open it up to some questions at the end. So let's dive right into the Guide to the Markets. There are several themes that need addressing in today's economic environment. The first being the Greek debt crisis, which I'm sure you've heard a lot about. Second will be the U.S. economy. Third will cover the Federal Reserve and the timing of interest rate hikes. Fourth will be profits and equity valuations for the U.S. Stocks. And fifth, we'll discuss some global investment opportunities. So let's kick things off on page 45 of the guide, where we'll actually be discussing Europe, sovereign yields, and fiscal austerity. The right-hand side of this page shows that, contrary to popular belief, Greece has actually pulled their deficit down by 9.5% over 3 years. Because of the austerity that's been imposed upon them by Europe, it's not difficult to believe why Greek voters voted no for the most recent referendum. Yet, it is also not difficult to understand why the rest of Europe is reluctant to lend more money when they may not get it back. If the Syriza government is winning in Greece, it may empower other left-wing governments in Italy, Spain, Portugal, etc., to follow the same path. We believe that even if Greece does come up with a new proposal, Europe will most likely decline. The most important question for investors is, will there be contagion? Will the Greek debt crisis spread? And recent volatility may be due to a fear that the situation in Greece may be contagious. In reality, it is likely not contagious, given three possibilities: economic, financial, or political collapse. First, Greece is really insignificant from an economic perspective. They only make up roughly 2% of European GDP. Second, from a financial measure, the bailout program was designed to get the Greek debt off the books of European banks and onto the books of governments, the ECB, and the IMF, which can actually handle the debt. And lastly, for political collapse, it's unlikely that any European elections in the coming months will result in the rise of an opposition party, although Italy may be a long-term threat. Let's move forward and really discuss the economic growth and the composition of our GDP here in the United States. This is an important one on page 18 because the first quarter GDP numbers were really quite weak. Recent numbers suggest second quarter GDP may actually be around 3%, which would be a much healthier sign for the U.S. And the right-hand side of this page actually shows what we call a checklist for the economy, or the components that actually make up GDP domestically. So housing is, of course, going to be a big contributor. Investment spending data is mixed right now. It may slightly add to growth going forward. Government spending will not add too much, but there is growth in construction spending, which is a good sign. Consumption spending looks to be better than 3%, and net exports likely won't be a drag in the second quarter as they were in the first quarter. So we may actually see a revision in the seasonal adjustment process in the last few years, which could get rid of the drag of negative 0.2% in the first quarter to U.S. GDP. And if the first quarter gets revised to positive 1%, it may take something out of the second quarter. Overall, we will likely see a bounce back in the second quarter of 2015. It's also important to note on this page the economic growth and composition of GDP. When it comes to real GDP in this left-hand chart, you'll actually see the expansion average coming out of this Great Recession was only 2.2%, which is far less than the historical of 2.9%. So a slower growth, slower pace of the recovery, and going forward is what we're going to discuss next. So let's take a look at some of the leading indicators, which we define as the cyclical sectors in the U.S., which is on page 20 of the Guide to the Markets. The right-hand side of page 20 shows manufacturing and trade inventory. So we've actually seen a significant tick-up in inventories as of the last reading of April of 2015. We're also seeing that elsewhere in government data, which suggests there may be a problem with manufacturing inventories because companies will need to work through this in order to stop detracting from growth in the coming quarters. Overall, we think growth will bounce back to 3%, but will slow to maybe 2.5% going forward. This is a repeat pattern throughout this expansion. Growth is not picking up the way that it used to, and we're likely not going to see a 4% growth rate number or even a 3% growth rate on a regular basis. With the American economy, this may actually be the new normal, which is what I discussed on the prior slide, just a slower pace of recovery than historical standards. Moving forward, we've taken a look at the cyclical sectors for short-term growth. Let's take a look at the long-term drivers of economic growth on page 22. The right-hand side of page 22 shows GDP growth over the last 6 decades broken down into growth in the number of workers and growth in real output per worker, which creates the total of growth in real GDP. Now we've averaged 3.8, 3.5, 3.3, 3.1, and now we're down to 1.6, 1.7. So over the last 50 years, we've averaged 3.4%. Now all of that is essentially gone. The bottom left-hand side of the slide actually shows that we're not doing enough investment spending growth, and that is taking away from productivity growth. The number of workers is going to quickly reduce growth in the labor force. We're on the top left-hand chart now, and population demographics of people aged 16 to 64 show that this is going to be even slower in the next decade. Over the next year and a half, we may have a growth rate of 2.5%, but if the unemployment rate reaches 4%, which we'll touch base on in a couple of slides, and doesn't fall any further, growth will have to be under 2% by 2017, or else this economy is going to overheat. So let's take this one step further, and on page 24, let's address unemployment and wages in the U.S. The unemployment rate has fallen from 10% in October of 2009 to 5.3% today. It's a great number. Wage growth, however, is still very weak at only 1.9%. However, there also isn't enough history in better measures of wage growth to show a pickup in compensation right now. So the real question is, why have wages been slow to tick up in this economic expansion? The answer is that inflation is low. So workers are not demanding higher wages because their costs aren't going up. Also, with less productivity growth, as we mentioned on the last slide, businesses are not inclined to supply wage increases. Said another way, if employees are not being more productive, why would we pay them more money to do the same job that we're paying them today? Another good question is, will the unemployment rate, i.e. the brown line, and wage growth, i.e. the blue line, move closer? We do think that they will probably move closer, as the unemployment rate will come down a bit and wage growth will come up a bit. If this is the case, then the Fed's criteria for tightening or raising interest rates have finally been met. Also, if the dollar stabilizes and wage growth stabilizes, the Fed will be confident that we will head towards that 2% inflation number, which they've been targeting for the past 6 years. So some signs of good life here with unemployment coming down and wages slowly growing. So we mentioned that the Fed may hit their targets for long-term inflation, unemployment, and GDP. Let's actually take a look at, on page 3, the Fed and interest rates. So this is a very cool chart because it actually has a lot of really important data that we're focusing on today. On the top line, in the separate box, the FOMC June 2015 forecast, the Fed expects a 1.9% growth rate in GDP this year. We actually believe this to be correct. We have 2.6% for next year. We also believe that to be correct. 2.3% in 2017. That's unlikely in our view. And 2.2% in the long run, which we also think is unlikely. We believe that the long run growth will be closer to 1%, maybe 1.5% until the baby boomers' retirement is complete. We mentioned that on the slowdown, the long-term drivers of growth in prior slides. We also do not agree with their unemployment forecast, which is currently at 5.3% for the fourth quarter of this year. Guess what? We're already at 5.3%. We think that we will be closer to a 5% number at the end of this year. The unemployment rate could fall over a percentage point to 4% by the fourth quarter of next year in 2016. The Fed is expecting 2 rate hikes this year. You can see that in the blue diamonds when you take a look at the FOMC year-end estimates. 0.13 to 0.63, that's 2 25 basis point hikes. They expect 4 interest rate hikes in 2016 and 5 in 2017, which sounds about right to us. We think we will have the first rate hike in September of this year. We know that we are expecting a skip in the October meeting by the Fed, and then a second rate hike in December is likely. It seems the Fed is anticipating skipping every other meeting in 2016, but they may find that the labor market and inflation are heating up faster than expected, in which case they may have to move rates faster. So interest rates go up for one reason, and interest rates go up because the economy is getting better. Let's move forward to page 7, which will show corporate profits and leverage for the S&P 500. And analysts are actually expecting a turnaround in profits. Operating earnings were down 5.3% year over year in the fourth quarter of 2014 and 5.5% year over year in the first quarter of 2015. In the second quarter of 2015, analysts are expecting a 3.1% year-over-year decline, and it is possible that we will actually be flat for a second quarter of 2015, and on the upside, finally showing growth in the third quarter of 15 and the fourth quarter of 15. However, meaningful gains may come next year, with possible double-digit gains for the S&P. Overall, we will see a rebound in profits this year with bigger gains in 2016. So this is important, and what we want to do is focus a little bit of a deeper dive on the next slide, page 8, which will show sources of S&P 500 earnings. So a lot of the questions that I'm sure you're asking yourselves right now is why were first quarter earnings down? The simple answer, as you can see on this chart, is because of oil. Energy was clearly a big drag on earnings. Now, we don't believe that the underlying earnings of the U.S. energy companies were actually negative. We will probably see some pickup in earnings growth in the second quarter and the rest of the year, even if oil prices don't go up from here. When it comes to the dollar, on the bottom left chart, you'll actually see 54% of U.S. corporate revenues came from inside the U.S., which means that 46% of revenues came from outside the U.S. And on the right-hand side, you can see how much the dollar has gone up, roughly 18% in the second quarter of 15. And this implies a big translation effect, which is pushing down the value of foreign earnings. Said another way, if you're generating 46% of your revenues from outside of our borders, you have to repatriate that money back into U.S. dollars, which means you're going to take the haircut because of our improving stronger dollar relative to the local currency that you're playing in. Overall, earnings are looking quite nice. If you were to look at the top right of this chart for the first quarter of 2015, which we spent some time speaking about, the S&P 500 declined earnings by 5.6%. However, if you took out energy from that conversation, earnings in the United States was up 8.5%. So other areas like financials, healthcare, industrials, technology, telecom, and utilities all were positive in the first quarter of this year. So we've talked about earnings. We've talked about the dollar. Let's spend some time now talking about energy on page 29, in which case we'll discuss some of the supply, demand, and the prices of oil. The bottom left-hand side of page 29 actually shows that inventories fell by 300,000 barrels a day in 2013. Inventory grew by 1.1 million barrels in 2014 and 1.9 million barrels a day in 2015. Forecasts show they will grow by 800,000 barrels a day in 2016. So the EIA is assuming that the effect of a 50% reduction in oil prices, which we've seen, will gradually shut down production and increase consumption. We believe this to be correct, and therefore we expect oil prices to be higher a year from now. If oil prices increase, this will help U.S. corporate earnings. Another big issue that I'm sure you're aware of is the Iranian deal, which complicates things. But if the U.S. Congress will approve a deal, Iranian oil will seep into the world markets over the next year, creating further supply and will have implications across the prices globally. So that's just a quick snapshot on energy. Let's spend some time talking about trade and the U.S. dollar on page 28 of the Guide to the Markets. This page reveals two things. First, it reveals that the dollar is too high. Second, the long-run dollar will actually come down. The dollar is too high because we're running at a big current account deficit. While oil may play a small part in that, the trade deficit will probably get worse. Europe, Japan, and emerging markets are all running current account surpluses right now. We are running at a trade deficit because our assets are too expensive and everyone else's are too cheap. If your trade deficit is causing a demand for foreign currency, then it will tend to push the foreign currency up and your own currency down. It is a weak force that is getting interrupted by people's assumptions about how markets will react to Fed interest rate tightening. If the European economy will improve over time, the euro will go up. And if you believe the euro will go up in value, it may actually be better to invest in European stocks unhedged. If the dollar is flat or down and oil is flat or up, profits will gradually recover. So the energy conversation and the dollar conversation are two very important things that we're focusing a lot of our attention on, and so should investors. So let's move forward to one of the other major topics that we're going to be discussing on today's call, which is S&P 500 valuation measures, which are on page 5. This is a new chart to the Guide to the Markets that we've included in the third quarter of this year, and it's one of my favorites. Page 5 shows the forward PE ratio, which is operating earnings expected over the next 4 quarters, divided by the current price. The forward PE on the S&P 500 is currently 16.4, while it has averaged 15.7 over the last 25 years. Thus, we are only slightly overvalued. The biggest anomaly is still in the relative earnings of stocks and bonds, which you can see in the top right box, the valuation measures of earning yield spread. Stocks still look cheap relative to yields that you can achieve from bonds, cash, or inflation. So while we don't think the market is overvalued, we expect only single-digit returns going forward. So people think that the market is at an all-time high, which it is. People think that we are due for a sell-off. This chart actually tells us that we're not even a full standard deviation, which would be 19 times on a forward PE ratio. We're currently at 16.4, so while growth will be harder to find, i.e. high single digits, there is still room left to run in equities, perhaps. Let's now talk about manufacturing momentum. Manufacturing momentum is one of the key leading indicators that we look at not only for U.S. companies, but we also look at opportunities on a global basis. It's on page 44 of our guide. And the way you read this chart is very simply, green is good, yellow is neutral, and red is bad, i.e. you're in a contraction phase. So green is expansion, red is contraction. So essentially PMI, which is what we're looking at this chart, is a leading indicator because if countries are manufacturing more goods and services, that should lead them to hire more people to actually build and sell those goods and services, which means that global unemployment should trend lower, which means that incomes and wages should go higher, which means that consumer spending should go up because people have more money in their pocket. As we know in the U.S., for example, we're a 70% consumption-driven economy, therefore having higher growth rates. So in a nutshell, PMIs in emerging markets look weak currently. We're going to talk about emerging markets at more length in a few slides. And the manufacturing in developed markets look okay right now. So very good manufacturing data. Let's now look at the inflection points on the S&P 500 and really what it compares to U.S. and international on the next slide. So this slide shows that over the past 6 years, coming out of the March of 2009 lows, the S&P 500 is up 205%, and we are currently trading at a higher price than our 2 previous peaks. In the middle box, you can see some characteristics that we look at. The PE ratio is above its historical average, as we mentioned. Dividend yield is currently higher than it's ever been. It's at 2%. And the 10-year Treasury is, of course, lower than it has been as well. So people immediately look at this chart and say stocks have to sell off. It has been too far of a bull market. And the bulls automatically say, well, wait a minute. If the market's trading at 16.4 times forward PE, where it is today, the far left side of this chart shows that the PE in December 31st of 1996 was also trading at 16 times forward PE, and the market went up another 106% from there. So the future is uncertain. We do believe single-digit growth for the S&P 500, but there is no denying that we have come a long way in a short period of time. Page 43 on the next slide is actually the same chart that we just showed you for the S&P 500, only now we're looking at the developed MSCI EAFE, which is the developed international benchmark, at its inflection points going back to 1997. So what you can see here is that the EAFE is actually lower and cheaper than it was in 2007. We're only up 104% compared to the 205% for the U.S., and it has a higher dividend yield and is currently cheaper relative to German bonds. Earnings are moving up in Europe as the economy improves, and there may be a lot of opportunity in European stocks as well as some opportunity in some Japanese stocks. So a great case for investing overseas at some cheaper prices, some potential cheaper valuations, and some higher dividend yields. Here is that slide on page 50, which discusses the emerging market snapshot that I mentioned we would get to. Page 50 shows the difference between emerging markets and developed market growth and the ratio of MSCI emerging markets to MSCI developed markets. Emerging market stocks are underperforming relative to developed country stocks. This is because of the expectations that economic growth rates are declining in emerging market countries. Everyone seems to be very negative on emerging markets today, but the commodity cycle may be coming to a close and very close to its bottom right now. So China is growing more slowly, but also India is growing very rapidly. Meanwhile, developed markets are running out of available workers. Unemployment is 5.3% in the U.S., and it's actually 3.3% in Japan. Overall, the U.S. and Japan will grow more slowly, and emerging markets will grow more quickly. Since the gap between emerging markets and developed markets will widen, emerging market stocks will probably do better in the long run, but there is some big question marks in the short-term profile. Let's take a look at now the developed market divergences. Let's go to page 35. So we've discussed emerging markets, we've discussed opportunities abroad. Let's now take a look at the way that some of these developed markets are taking changes and the different paths being taken by central banks globally. The U.S. and the UK could see nominal GDP growth at all-time highs, while Europe and Japan are lagging behind. If you look at the balance sheets on the top right, you'll see that the Bank of Japan and the ECB are expanding their balance sheets, while the Bank of England and the Fed are not. Expectations for interest rate hikes are anticipated for later this year or early next year for the U.S. and UK, but not for many years for the ECB and the Bank of Japan. Simply stated, if you want to invest in fixed income, we're not going to expect to be beaten up by a tightening central bank because there are opportunities in Europe and Japan. It's important to diversify fixed income globally, is what we're trying to say there. Within the global fixed income landscape, another big portion of that pie is actually emerging market debt, which we'll take a quick glance at here on page 40 of the Guide to the Markets. So the right-hand side of page 40 shows the U.S. dollar-denominated sovereign debt yields relative to U.S. Treasuries. So for example, in India, you can actually get 1.66% higher on sovereign debt over U.S. debt, which the maturity is only 4.8 years. So said another way, it is unlikely that India will default over the next 4.8 years, so you enjoy a nice coupon cushion by investing in emerging market debt. In regards to emerging market debt, you need an experienced manager to figure out where the credit risks are. Emerging market debt is a very complex portion of the market. You not only have to focus on real policy rate changes, you also have to focus on credit ratings, non-investment grade, investment grade, and there's a lot of moving parts there. So we always recommend hiring a professional money manager to do that within your accounts. So we've discussed a multitude of things today, from headlines to risks to opportunities. Page 54 really sums up our views on the market and why we believe in building strong, stable portfolios for the long run. The biggest distortion in financial markets today is, in fact, that cash is paying you zero. Central banks have made it so you can only make money through investing in risk assets rather than saving it in banks or CDs. The global economy is doing okay, yet people are getting distracted by Greece and other headlines. The U.S. economy is doing better, and valuations are not too high in the equity markets, and it's a good time for investors to take advantage of corrections and uncertainty to get invested in long-term assets. This is especially true when, again, short-term assets are paying zero. So this chart, which I refer to as the Skittles chart, shows the historical returns for the past 15 years in a multitude of asset classes. What we want to note here is that it's very difficult to pick which asset class is going to be the best performing in a given calendar year. Right out of the gate in 2000, you'll see that commodities were the #1 performing asset class that year. In 2001, commodities were the second worst performing asset class. It's a very volatile swing if you only pick one asset class for your investments. If you design an asset allocation portfolio that is composed of a multitude of asset classes, countries, stocks, bonds, alternatives, etc., you will have a much smoother ride in terms of your volatility, and you also generate productive returns, which are highlighted on the right side. For example, the 15-year annualized returns for asset allocation returned 5.3% when compared to large cap stocks in green, which is the S&P 500, at 4.2%. So roughly 20% higher returns than just investing in equities over the past 15 years. And you did that with roughly 4% lower annualized volatility, which is the column just to the right of that. So build portfolios for the long term that are suitable for your risk profile and your long-term investable goals. And Tony, that really comes to the end of my comments. If you'd like to open it up for any questions, I'd be happy to address them now.
Great. Thank you so much, Jack. We really appreciate you sharing your time and knowledge with all of us here today. And as you mentioned, we will now start addressing some of the questions that have been filtering in. And audience, please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to ACECRT's Financial Wellness Help Center. We'll go ahead and pull that information up on the screen for you now so that you have it. So you can reach out to ACEC's Financial Wellness Help Center via email at financialwellness@acecrt.com or give us a call at 844-ACECRT-8. And some of those questions that have been filtering in, we'll go ahead and get started with those. So the first one, Jack, is what effect does the American population's debt have on the economy, and what and who are impacted by this?
So that is actually a great question. When you're taking a look at the debt of both the U.S. government and when you look at the actual consumers, the debt has actually come down significantly over the past 6 years for both the U.S. government and for consumers. The U.S. deficit, for example, has shrunk from roughly $1.5 trillion in 2009 down to just under $500 billion today. The U.S. consumer is also in a very healthy position. They actually have a ratio of assets to liabilities that comes to the tune of about 6 times assets in favor of liabilities. So people and companies and governments have done a great job of lowering their overall debt obligations over the past 6 years. So that drag is actually going to be significantly less of a risk going forward.
Great, thank you, Jack. Our next question is, as our supply of oil continues to be depleted, what effects do you think this will have on the U.S. economy?
So the oil supply here in the United States is actually one of the largest areas for supply. So depleting it is not a major concern. If you actually take a look at the supply that we went back to on page 29, and Tori, if you want to either pull that up or send that back out, the U.S. currently has grown the supply, i.e. increased production, 21.8% growth since 2013. So running out of U.S. oil supply is not really a major issue. The issue is more concerning that we are bringing too much oil to market, and that is a concern for other OPEC and oil producing countries around the world.
Thank you, Jack. Our last question is, if we're predominantly a consumer-based economy, why are our manufacturing statistics higher than other foreign markets?
So the manufacturing statistics are where the actual products are being made and manufactured, while the consumption is being based here in the United States. So we are essentially buying more goods and services than the historical averages from outside of our borders. So when you hear about lack of job growth in the United States, it's because a lot of those jobs have been outsourced to other countries around the world where essentially you can manufacture those goods and pay lower salaries and wages to those people. So manufacturing has picked up outside the United States because of the competitive landscape and because of their cheaper currencies. So we are the major buyers of goods and services, but yes, they are being generally manufactured outside of our borders.
Great, thank you, Jack. It doesn't appear that we have any more questions at this time. Audience, as I mentioned, if you have questions that come up as you're looking through the guide, please don't hesitate to reach out to us via email or phone. Thank you, Jack, again for your time, and thank you, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.
Thank you. Have a great day.